We are taking things at a very deliberate, very analytical pace today.
Taking it step by step.
Exactly. We are looking at a structural market reality that is actively tearing the traditional software as a service model apart from the inside out. For years, people whispered about this, the SaaSpocalypse.
Right. It says apocalypse usually as a theoretical risk in white papers.
Yeah, just a theory. But today, it's the water we are swinging in. And our mission in this deep dive is to unpack two very specific discoveries from our research.
Two big ones.
Right. First, we are going to expose the hidden margin trap.
Oh, this is fascinating.
It is. It's the brutal unit economics that are making it almost completely impossible for traditional SaaS companies to just pivot to AI, even though their PR departments claim they are doing it seamlessly.
They definitely aren't.
Yeah.
And the second discovery is, well, it's the escape route.
Right. The way out.
Because while a massive portion of the software sector is basically marching toward a cliff, a specific subset is doing something completely different. They are utilizing an open-sourced blueprint pioneered by Strategy Inc.
Which we will get deep into.
We will. They are adopting a Bitcoin treasury model. And what we're seeing in the research is that this is no longer some fringe financial experiment.
Not anymore.
No, it's rapidly becoming a mandatory, mathematically verifiable survival tactic, specifically for these mid-market software companies facing AI disruption.
So by the time we map all of this out for you, you will see exactly why the middle ground of the software market has completely evaporated. And you'll have a framework for how corporate value is being fundamentally redefined right now.
Welcome to the Deep Dive. I'm Satosha.
And I'm Satoshi. So let's start with that market split. You mentioned the market dividing into two camps. On one side, we have what the market has clearly crowned as the blessed.
The builders.
Right, the AI infrastructure builders, the Googles, the Oracles, Microsoft, the companies going full throttle. But let's ground that full throttle mandate in physical reality.
Good idea. Well, physically, they're attempting to conquer physics. I mean, literally. When you look at what Oracle's deploying these liquid-cooled NVIDIA Blackwell racks at a zettascale level, you have to understand the thermal dynamics at play here.
Because it's not just a normal server room anymore.
Not even close. We are far past the era of a standard air-conditioned room with raised floors. The sheer density of compute required to train these frontier AI models, it generates heat that would literally melt the silicon if you relied on ambient air.
Melt it. Just turn it to slag.
Yeah, literally destroy the chips. So they are laying miles of specialized plumbing, actually pumping advanced coolants directly over the chip packaging.
I want to pause on the word zettascale for a second, because we use these prefixes so casually now,
They really do.
A megabyte, a gigabyte, a terabyte. For anyone listening, just think about this. A zettabyte is 1 trillion gigabytes.
It's a number so large it's hard to visualize.
Right. So when a company is building zettascale infrastructure, they are constructing digital factories capable of processing data at a volume that represents a significant fraction of all human information ever recorded.
Which is mind-boggling.
It is. The capital expenditure required to build a facility like that, to secure the power contracts from the local grid.
Oh, the power requirements are insane.
Exactly. It often requires dedicated nuclear or advanced geothermal setups just to run the building. That is a moat so deep that no traditional software company could ever hope to cross it.
And that's exactly why the market has rewarded them so heavily.
Yeah.
They are operating at the foundational layer. I mean, if you are building the roads, right,
Yeah.
and you're charging a toll for every single vehicle that passes over them, you don't really care which delivery company wins the logistics war.
You just want traffic.
Exactly. You get paid regardless.
Yeah.
But that brings us to the other end of the spectrum. The companies actually trying to drive on those roads.
The sauce laggard trap.
Yes.
This is the dark side of that barbell economy we're seeing. Because for, 15
Just
years?
15 years, yeah.
For 15 years, the absolute greatest business model on earth was charging a company $20 a month per user for access to a cloud-based
So
dashboard.
basically printing money.
It was infinitely scalable. But right now, we are looking at the iShares Expanded Tech Software Sector, ETF, and it's down 22%.
Just bleeding.
Yeah, you have roughly 40% of the S&P 500 tech components staring down a negative year. And these are household names, enterprise giants, just
Yeah.
bleeding out.
And the really scary part is that the bleeding is structural.
Hmm.
It's not cyclical.
Meaning they won't just bounce back next quarter.
Right. They are starved for capital because the market realizes their core product,
Okay.
that dashboard, the workflow tool, the seat-based license you mentioned, it's being commoditized by the very AI infrastructure we were just talking about.
I want to take a recursive check here, just to speak directly to you listening, because we are painting a picture of a market that has absolutely no middle class left.
Zero middle ground.
Right. Does this make sense so far? You are either building the massive liquid-cooled data centers and charging rent, or you are a traditional software company trapped in a burning building, basically watching your valuation collapse.
It's a stark reality.
It really is.
Sure.
And if you want to visualize these market shifts and really dive into the granular data we are pulling from, you have to check out our research hub.
It's a great resource.
It is. We built it specifically for this kind of deep, focused reading. There are no trackers, there are no cookies, no pop-up ads, and no login required.
Just clean text.
Yeah, it is just pure, unadulterated reading, like the way the internet was supposed to be before all the clutter. The link is right down in the description.
And the technical architecture of the hub is actually highly relevant to our discussion of modern deployment, too.
Oh, definitely.
The deep dive website is now a progressive web app, or a PWA.
Yes, and I absolutely love this feature. If you navigate to the link in the description, you can actually install the hub as a native app straight from your browser.
Super easy to do.
Yeah, whether you are on a PC, a tablet, or even just your smartphone, because it caches the data, you can take all this deep finance research totally offline.
Which is huge for travel.
Exactly. You can read on a beach or on a flight without paying for expensive airplane Wi-Fi or draining your mobile data. It just works seamlessly.
So, having established that massive divide between the infrastructure giants and the legacy software companies, we kind of have to ask the critical question.
The million-dollar question.
Right. If you are a legacy SaaS CEO,
Right.
and you see this AI wave coming, the obvious boardroom mandate is simply pivot to AI.
Right. Just integrate an LLM into our dashboard, add a chatbot.
Exactly. So why does the research indicate that this seemingly logical pivot is actually a fatal margin trap?
Well, let's explore the cannibalization paradox.
The math on this is brutal.
It really is. Because on the surface, upgrading your software shouldn't kill your company.
It sounds like a good thing.
Right. But it all comes down to the brutal reality of unit economics. Let's look at the historical SaaS model. A company like Salesforce or Adobe, they operate on gross margins of roughly 80 to 85%.
Huge margins.
Yeah, meaning for every dollar a customer pays, the cost to deliver that software is only 15 to 20 cents.
And the reason delivering that software is so cheap is because traditional computing is largely retrieval-based.
Break that down a bit for us.
So when a user logs into a CRM and asks to see a client's history, the software is really just pinging a centralized database.
Just fetching a file.
Exactly. It retrieves a few kilobytes of text and renders it on a screen. The actual compute cost of that database ping is, well, it's a fraction of a cent.
But the moment you introduce generative AI into that workflow, the physics of that transaction change entirely, don't they?
Night and day difference.
Because you aren't just retrieving static data anymore. You are synthesizing it from scratch.
Right. And synthesizing data requires inference.
Inference is the key differentiator here.
It absolutely is. Every single time a user asks an AI agent to draft an email or analyze a spreadsheet or generate some predictive model, that query doesn't go to a simple database anymore.
It has to go to the big brains.
Right, it goes to a large language model hosted on those massive liquid-cooled NVIDIA clusters we just discussed. And the legacy SaaS company, they have to pay the infrastructure giants for that compute power.
They have to pay the toll.
Exactly. We call it the API toll.
So here is the trap. Our research shows that when traditional SaaS companies transition to these AI-driven features, their gross margins basically collapse.
It's a nosedive.
Yeah, they go from that historical 85% down to an average of 52%.
Which is devastating for a software company.
It is. I want to push back on this just to unpack it. Because if I am a CEO and my CFO tells me that our shiny new flagship AI feature is going to cut our profitability by 30 points.
You'd panic.
Right. My instinct is to kill the feature. Just scrap it. So why do they launch it anyway? Why willingly make less money per user?
Because they have a gun to their head. basically. It's an expectations gap.
Okay, explain that.
They are trapped between their historical profit profile and the new baseline of what customers expect.
Yeah.
If they don't offer the AI feature, the enterprise customer just churns immediately to some startup that does offer it.
So they are forced to play the game.
They have to. So they roll out the feature, hoping, crossing their fingers that they can charge a massive premium to offset those compute costs.
Like an AI add-on subscription.
Right. But the enterprise customer pushes back. They refuse to pay double for software they already feel they are overpaying for.
It is literally a slow death by API fees.
It is.
And the stock market, they see this coming a mile away. The massive apparition of market cap for companies like Adobe or Salesforce, it isn't happening because millions of users canceled their subscriptions yesterday.
No, the revenue is still there today.
Right, because enterprise software is sticky. It takes years to rip out a legacy HR or ERP system. The stock is crashing today because the market is a forward-looking discounting mechanism.
Investors are modeling out that margin collapse over the next 5 years.
They see the writing on the wall.
Yeah, they see the AI transition not as a growth vector for these legacy companies, but as an uncontrollable capital expenditure drag. They are selling ahead of the disruption because they know the protective mode of these companies has completely evaporated.
And the invaders crossing that evaporated mode are actually coming from two completely different directions.
It's pincer movement.
It really is. First, you have the trillion-dollar big tech giants moving aggressively down market.
The Googles and Metas.
Right. Companies whose primary revenue used to be consumer search or social media advertising. They are realizing that as AI disrupts traditional web search, they need stickier enterprise revenue to survive.
So Google, Meta, Microsoft, they're looking at traditional enterprise resource planning, HR software, logistics tools.
The boring stuff.
Yeah, the boring but profitable stuff. And they are saying, well, we own the compute layer. Yeah. We can build an AI-native version of your core product and offer it at a fraction of the cost because we don't have to pay the API toll to a third party. We own the servers.
It is vertical integration literally weaponized against the mid-market.
Absolutely.
But the threat isn't just from the giants above, right?
Yeah.
It is also from the AI-native startups coming from below.
The ankle biters.
Exactly. And this brings us to a concept that kept coming up in the research. It's this perception of grandma's tech.
I love that term.
It's so accurate. To a 25-year-old creative director or a junior data analyst working today, legacy SaaS interfaces look hopelessly antiquated.
Just clunky and slow.
Yeah. They require dozens of clicks, manual data entry, rigid drop-down menus, complex workflows.
Because they were built for an era where the human had to translate their intent into a language the machine could understand.
Right. Clicking menus, adjusting little sliders.
Exactly. AI-native applications completely invert that paradigm. The machine just understands human intent directly. You just tell it what you want.
A brilliant example of this specific disruption from our research is the Mosaic AI video editor.
Oh, this is a perfect case study.
It really is. Just look at what they are doing to the Adobe Creative Suite monopoly right now. For decades, if you wanted professional motion graphics or cinematic video editing, you paid the Adobe tax.
It was unquestioned. You just paid it.
Right. But Mosaic didn't just build a clone of Premiere Pro and, slap an AI chatbot on top of it.
No, that would be the legacy trap we just talked about.
Exactly. Instead, they built an entirely new architecture predicated entirely on generative motion and AI-assisted pacing.
Built from the ground up for AI.
Right. And the production speeds achievable with Mosaic make the legacy frame-by-frame workflow look, honestly, like a dinosaur.
It's the difference between typing out a letter on a manual typewriter versus dictating it to a hyper-competent assistant who also formats it for you perfectly.
That's a great analogy. And, I want to use Mosaic to kind of peel back the curtain on how we actually produce this deep dive.
Oh, let's do it.
Because we are actively living through this transition ourselves. The audio you are hearing right now, it is just one layer of what we do.
The entire production pipeline is a study in AI leverage, honestly.
It really is. Let's explain how these deep dives actually come to life for you guys. It starts with your signals. Listeners sending us sources pointing us toward complex, opaque market shifts.
That's stuff that's hard to parse.
Right. We take those raw inputs and we just obsess over them. We map out the hidden themes. Then we unleash Gemini Pro.
Our favorite internet detective.
Yes. We use it as a recursive research engine, going full internet detective to trace footnotes, validate corporate filings, and synthesize all these massive macro trends.
But of course, LLMs have tangents.
Oh, definitely. They wander off.
So we have to chase and tame those outputs with some highly specific prompt kung fu.
Lots of prompting. But the crucial thing is, the AI doesn't write the final product.
Never.
It accelerates the synthesis, sure, but human obsession has to take over to validate the claims across thousands of signals. We painstakingly handcraft and refine every single word of the narrative to ensure these complex economic mechanics translate into tight, no-fluff audio.
Compressing days of research into this hour.
Exactly. And then we design the sound, the mood, and the visuals. And for the video production side, we rely heavily on Mosaic.
It's incredible for that.
It is. We build the motion graphics using Mosaic's engine to create minimalist, clean, high-contrast typography. We utilize simple geometric accents and subtle kinetic text reveals to emphasize key data points, like that 553 billion Oracle backlog.
It makes the data pop without being distracting.
Right. By leveraging strong hierarchy and white space with Mosaic, we achieve a calm, premium pacing that simply wasn't possible for a small team even a couple of years ago. Mosaic is an absolute game changer when it comes to video.
It proves the exact point we were making about the SaaS market, too.
How so?
Well, a small AI-leveraged team can output enterprise-grade quality now, completely bypassing the legacy software gatekeepers.
We don't need the legacy tools.
Exactly, which brings us right back to the grim reality facing those legacy gatekeepers.
They are in a really tough spot.
They're operating in a state of superposition. The research describes it as a Schrodinger's cat scenario, which is remarkably apt for corporate finance.
Let's drill into that Schrodinger's cat idea because it perfectly captures the anxiety of a mid-market CEO right now.
It really does.
The company is simultaneously alive and dead.
Let's unpack the alive part first.
Okay. So they are live because those 3-year legacy enterprise contracts are still paying out. The monthly recurring revenue is still hitting the bank account.
The cash flow looks healthy today.
Exactly. But they are dead because they are actively losing the R&D war against the infrastructure giants and the nimble AI-native startups.
And because of that dual state, pivoting to AI is essentially opening the box to find the dead cat.
Oh, that's brutal.
It is,
Yeah.
because launching the AI feature destroys their margins and accelerates the realization from the market that their software is actually just a commodity.
Right. It ruins the illusion.
Yes. So what does a mid-tier SaaS company do? They can't win the compute war against Google. They can't maintain their historical 85% margins.
Or boxed in.
This is where we introduce the alternative, the 100% mathematically proven escape route.
The Strategy Inc. blueprint.
The Sailor playbook.
Right. Now, when we talk about Strategy Inc., most of the market knows them by their former name, MicroStrategy.
Sure.
And they associate them entirely with Michael Saylor and Bitcoin, just a crypto holding company.
That's the public perception.
But I want to heavily emphasize the origin story here because it is the crucial link for these SaaS companies. Strategy Inc. was not founded as a cryptocurrency hedge fund.
Not at all. They were a pure-play business intelligence and enterprise software company.
They sold legacy SaaS tools.
Exactly. And 5 years ago, they were staring down the exact same barrel that every mid-market SaaS company is looking at today.
The exact same line.
Yeah, they were a slow-growth software vendor trapped in a highly competitive market, realizing that their core business was essentially melting ice.
So Saylor looked at the macroeconomic environment, he looked at the limitations of his software product, and he realized he could not out-engineer his way out of the trap.
You can't code your way out of a margin collapse.
Right. So instead of trying to artificially pump the software revenue with gimmicks, he open-sourced a totally new corporate playbook.
He changed the game entirely.
He transformed the fundamental mandate of the company. He weaponized the balance sheet.
That's a great way to put it.
Instead of allowing the company's value to be dictated solely by its software sales multiples, which were shrinking, he initiated a massive capital allocation strategy focused entirely on accumulating a pristine, capped supply asset,
Bitcoin.
Bitcoin. Let's lay out the metrics of that conviction, because I want to be clear, it wasn't a PR stunt.
Yeah. Or just some 1% treasury allocation to test the waters.
Right. They raised over $25 billion through convertible notes, equity offerings, and strategic debt. And they poured every single cent of that into Bitcoin.
It's staggering conviction.
It is. Today, they hold 762,099 Bitcoin. They turned a boring software vendor into a fortified digital fortress.
And the mechanic they invented to do this is what we call the BTC yield engine.
Okay, loop back to that. What is the yield engine?
Well, they aren't just holding a static reserve of coins in a vault. They actively manage their capital structure to constantly increase the amount of Bitcoin they hold on a per-share basis.
So the stack is always growing relative to the shares.
Exactly. The legacy software business, the very business that was slowly dying, was repurposed. It is no longer the growth engine of the company.
What is it then?
It's the cash flow engine.
Right.
Its only job is to fund the ongoing treasury accumulation.
Okay, let me stop you right there. Let's put on our skeptic hats for a second.
Sure.
Because I am looking at this from the perspective of a traditional equity analyst, and I see a massive vulnerability in this logic.
What's the vulnerability?
If a software company just takes all its cash and buys Bitcoin, they aren't actually fixing their underlying software problem, right? The dashboard is still grandma's tech.
Yeah.
They're just abandoning their core competency to become a highly leveraged crypto hedge fund. So how does this actually save the software product from AI disruption?
Well, that is the exact critique traditional finance lobbed at Saylor for years.
It seems logical.
It does, but it completely misses the point of capital discipline. It doesn't, quote-unquote, save the software product from being disrupted by AI.
It does.
No. What it does is completely decouple the survival of the corporation from the hyper-growth requirements of the software market.
Okay, walk me through that decoupling, step by step. How does changing the treasury save the corporation if the software is still getting disrupted?
Think about why a SaaS company is forced into the margin trap of AI in the first place.
They keep customers.
Right. But also, they have to continually show 20% or 30% year-over-year revenue growth just to justify their stock multiple to Wall Street.
Because they're priced as growth stocks.
Exactly. If growth slows even a little, the stock crashes, they can't retain their top engineering talent, and the company basically dies.
Right.
But if the corporate treasury is anchored by an appreciating finite asset like Bitcoin, the enterprise value of the company grows even if the software revenue is completely flat.
Ah, I see. So the software business doesn't need to conquer the world anymore.
Not at all.
It just needs to be profitable enough to service the debt and buy more Bitcoin.
Exactly. It relieves the immense pressure on the R&D team. They don't have to engage in a suicidal AI arms race with Google because their shareholder value is being driven by the treasury accumulation, not by adding some flashy, margin-crushing chatbot to their dashboard.
That makes total sense. It transitions the company from a software growth model to a treasury accumulation model. The software just becomes a utility that funds the vault.
A cash cow for the treasury.
Right. But if this is such an elegant solution to the SaaS growth trap, why is this considered a blue ocean strategy?
That's a great question.
Because, why doesn't the CEO of Adobe or Salesforce adopt the BTC Yield playbook tomorrow? They have infinitely more cash flow than Strategy Inc. did. They could accumulate a massive treasury in a matter of months and just dominate.
They definitely have the capital, but they lack the structural freedom to actually do it.
What do you mean?
You have to look at the shareholder base of a trillion-dollar tech giant. Adobe, Salesforce, Microsoft. They're owned by the largest, most conservative pools of capital on the planet.
You're talking about sovereign wealth funds, legacy pension boards.
Yes, and massive passive ETFs.
The indexers. Vanguard, BlackRock, State Street.
Exactly. If the CEO of a Fortune 50 SaaS giant suddenly announced on an earnings call that they were pivoting their entire balance sheet strategy away from stock buybacks and dividends, and instead putting billions into a volatile digital bearer asset,
it would be chaos.
there would be an immediate institutional revolt. The board of directors, who ultimately represent those conservative funds, would fire the executive team before the market even opened the next day.
So the giants are structurally paralyzed.
Completely paralyzed.
Yeah.
They're too big to make that kind of radical treasury pivot.
That is a fascinating dynamic. Their massive size and institutional ownership is literally a straitjacket.
It is.
Which means if you are a mid-market SaaS company, say a $500 million to $2 billion valuation, you have a profound competitive advantage here.
A massive advantage.
If you try to fight the giants in AI, you are swimming in a red ocean filled with predators. You will be eaten alive by compute costs.
Definitely.
But if you pivot to a Bitcoin treasury strategy, you are swimming in a blue ocean. The giants literally cannot follow you there. You can aggressively accumulate this asset without fighting Microsoft for block space.
It is an open lane. And the market explicitly rewards the early adopters of these paradigm shifts.
We saw that with Saylor.
Right. Strategy Inc. was rewarded with a massive premium on their stock because they offered public market investors a totally unique vehicle.
A leveraged cash-flowing operating company intrinsically tied to Bitcoin.
Exactly. Other mid-market firms can still claim that premium, but the window of opportunity is aggressively closing.
And that leads us to the critical variable of timing. The research is very clear that this isn't a strategy to mull over for 2030.
No, it's urgent.
It is a mandate for right now, April 2026. So why right now? What are the converging forces that are forcing the hands of these software executives this quarter?
Well, it is a combination of a temporary pricing inefficiency and a tectonic shift in corporate accounting and lending laws.
Okay, let's break those down. Let's look at the pricing first. The research refers to this as the good luck window.
Right. Let's walk through the math on this window. In October of 2025, we saw Bitcoin hit a massive structural peak, reaching roughly $126,000.
It was all over the news.
But as we record this today, in April 2026, the market has entered a heavy consolidation phase. The asset is currently trading in the $66,500 to $71,000 range.
Which represents a 40 to 50% discount from the local top.
A massive haircut.
But critically, the underlying macroeconomic drivers haven't broken, right? Major institutional analysts, including Bernstein, are maintaining long-term cycle targets of $150,000.
Right.
So what is their thesis for that kind of price expansion from these levels? Because if the price is chopped in half, hasn't the momentum kind of died?
The speculative retail momentum has cooled, sure, but the structural accumulation has actually accelerated. Well, the spot ETFs that launched in recent years have fundamentally rewired the demand side of the equation. Wall Street has fully built the institutional on-ramps.
The plumbing is in place.
Exactly. Sovereign wealth funds and state pension boards are just now beginning to allocate. So you have a scenario where massive, slow-moving pools of capital are systematically buying an asset with a rigidly capped supply.
The halving cycles.
Right. The supply-demand imbalance is profound.
So for a mid-market SaaS company staring at AI margin trap, this pullback is an absolute gift.
It's the good luck window.
They can leverage their legacy cash flows to acquire a pristine treasury asset at a 50% discount to its recent highs, essentially front-running the broader institutional adoption curve.
Which is a massive incentive.
It is. But the research also points out that for many of these companies, it is no longer just a clever idea. It is becoming a mandate dictated by private equity.
Yes, this is where the strategy shifts from theoretical to mandatory.
Let's get into the weeds on this.
A massive percentage of mid-market software companies are either wholly earned by or heavily indebted to private equity firms.
The PE guys pull the strings.
Exactly. And PE firms are completely overhauling their risk models right now regarding corporate debt and collateral.
We really need to unpack the mechanics of this because it hinges on two very specific legal and accounting shifts that sound boring but are incredibly impactful.
They change the entire game.
Let's start with the accounting side. The research heavily cites FASB ASU 2023-08.
A catchy name.
Rolls right off the tongue. But for anyone who isn't a certified public accountant, what does the Financial Accounting Standards Board ruling actually change for a corporation holding crypto?
It changes everything about how digital wealth is verified and reported.
Okay, how did it work before?
Prior to this ruling, if a company held digital assets, they were subjected to what's called an impairment-only accounting model. Meaning, if the price of Bitcoin dropped even for a day, they had to take a permanent loss on their balance sheet, even if they didn't sell the asset.
Like a house that gets appraised lower.
Exactly. But here is the kicker. If the price went up, they couldn't recognize the gain until they actually sold it.
Oh, wow. So it actively punished them for holding it? It made holding the asset optically terrible for their quarterly earnings reports?
This is an accounting nightmare.
But FASB ASU 2023-08 changed that.
Yes, it mandated fair value reporting. So now, companies measure their Bitcoin holdings at the actual market value every single reporting period, recognizing both gains and losses in their net income.
Okay, let's compare that new reality to how a software company traditionally props up its balance sheet to get a loan from a PE firm. Usually they pledge their intellectual property, right?
Right, their IP.
They go to the lender and say, our proprietary code base and our customer list are worth $100 million. Please lend us $50 million against it.
But how does a lender actually verify that?
Right.
IT valuation is inherently subjective. It requires highly paid appraisers making wild assumptions about future market dynamics.
Lots of guesswork.
And more importantly, it is deeply illiquid. If the SaaS company defaults on their loan, the PE firm now owns a proprietary code base. What do they do with it?
Nothing. They can't just sell it on an exchange.
Exactly. They have to find a highly specific buyer in a distressed market. They might recover 20 cents on the dollar after 2 years of painful litigation.
Now contrast that with fair value reporting of Bitcoin under the new FASB rules.
It's night and day.
A PE lender looks at the balance sheet and doesn't have to guess. They can see exactly how many units the company holds, cryptographically verified on a public ledger, and they know the exact global, highly liquid market price down to the second.
No appraisers needed.
It transforms a subjective, illiquid balance sheet into a mathematically verifiable, instantly liquid fortress.
Which perfectly sets the stage for the legal enforcement mechanism.
Right, the second big shift.
UCC Article 12.
The Uniform Commercial Code. This is literally the plumbing of global corporate finance.
It governs how business is done.
Our research notes that Article 12 became effective in New York as of June 3, 2026. Walk us through the mechanics of this. How does Article 12 change the way a PE firm lends money to a software company?
Well, historically, if a lender wanted to secure a loan against intangible assets, they filed a UCC-1 financing statement.
Lots of paperwork.
It's a paper-based, highly bureaucratic system of establishing who gets paid first in a bankruptcy proceeding.
The lien priority.
Right. But Article 12 creates a brand new category of property called controllable electronic records.
Okay.
And it allows a lender to perfect their security interest in a digital asset, not through a paper filing, but through actual cryptographic control.
Let me make sure I am mapping this out correctly because this is massive. If a PE firm extends a $50 million credit line to a SaaS company, and the SaaS company uses that cash to buy Bitcoin for their treasury,
Yes.
the PE firm doesn't just file a piece of paper with the state saying we have a lien on this. They utilize a multi-signature custody arrangement, right?
Exactly.
The PE firm literally holds one of the cryptographic keys required to move the asset.
They have mathematical control over the collateral.
That fundamentally changes the entire risk profile. If the SaaS company misses a debt payment, the PE firm doesn't have to drag them into bankruptcy court for 3 years fighting over who owns the software patents.
No lawyers required for that part.
They just execute their cryptographic control over the Bitcoin. It is a perfectly liquid, globally traded asset that settles instantly. It is arguably the most superior form of collateral ever designed for corporate lending.
And because it is superior collateral, PE firms are beginning to demand it.
They want the good stuff.
They are looking at their SaaS portfolios and realizing that funding AI R&D is highly speculative and likely to fail, but funding a Bitcoin treasury backed by Article 12 control is mathematically sound. They are literally forcing the capital discipline onto these executives.
We are watching the deepest layers of commercial law and accounting rewire themselves in real time to accommodate this asset. And the software companies that understand this legal plumbing are the ones that will actually survive the AI transition.
The ones who adapt survive.
If you are tracking with us on this, if you geek out on the intersection of deep corporate finance, cryptography, and commercial law, you are absolutely our kind of people.
It really requires a synthesis of highly disparate fields to see the full picture here.
It does. And if this level of analysis brings value to you, we want to ask you to share this deep dive with your network. Send it to your colleagues, drop it in your finance group chats, or share it wherever you debate corporate strategy.
Word of mouth is huge for us.
It is the only way we scale this level of research. For the audio feed, we are available on Fountain.fm, Spotify, Apple Podcasts, and YouTube Music. All those direct links are neatly organized on our research website, linked right down there in the description.
And we are also putting a lot of focus into our visual outputs right now, too.
Yes, for those who prefer visual data, we are posting short, highly focused videos on YouTube and Spotify under the channel name Slopcast.
Slopcast, yeah.
As we mentioned earlier, we are using the Mosaic AI video editor to build out our long-form aesthetic, so the current short videos on Slopcast are very much a test phase for our pacing and typography.
We're still dialing it in.
We actively want your feedback on them. The guiding principle is to keep the visuals simple, calm, and entirely free from the hyperactive edits that dominate most media today.
We want a clean experience.
And speaking of Mosaic, they actually dropped a new application yesterday called Motion.
It is a remarkable piece of software for this specific workflow.
It is exactly what we have been waiting for. It streamlines the creation of minimalist kinetic typography even further.
It's so smooth.
If you are a creator, a designer, or just someone interested in how AI is accelerating visual production, we highly recommend our community take a look at it. We dropped the link to Motion in the description as well.
So bringing all of these threads back together, We can see the full architecture of the SaaS apocalypse now.
Let's synthesize the massive journey we've taken today. We started with the evaporation of the middle ground. The AI infrastructure giants are pulling half-trillion-dollar backlogs, locking up the future of compute, while traditional seat-based SaaS companies are bleeding market cap because their core product is being commoditized.
Right. And then we examined the margin track.
The 85 to 52% drop.
Exactly. The realization that attempting to pivot to AI destroys historical SaaS profitability because generative inference costs exponentially more than simple database retrieval.
And finally, we mapped out the legal and financial frameworks.
FASB fair value reporting and UCC Article 12.
Yes, the plumbing that makes the Strategy Inc. playbook not just viable, but optimal.
The verdict from the market, especially from the private equity firms controlling the debt, is that the era of waiting and seeing is over.
You can't just sit on your hands anymore.
Speed and transparent execution are the only metrics that matter in 2026.
These legacy SaaS companies are sitting at the bottom of a deep hole dug by their own structural inertia. And they basically have two choices.
Only two.
They can choose option A, burn billions of dollars of capital they don't have, completely tanking their profit margins, to wage an R&D war against trillion-dollar giants who literally manufacture the chips the war is fought on.
Which is a suicide mission.
Or they can choose option B, adopt a mathematically proven BTC yield strategy.
The sailor way.
Stop trying to out-engineer Google and start using legacy software cash flows to systematically accumulate the scarcest asset in human history.
It's the only logical choice.
And that leads to the final provocative thought I want you to mull over as we wrap up today.
Leave them with something big.
Emulating the Strategy Inc. Playbook isn't just a clever financial hedge. It might literally be the only proven path left for a mid-market company to cleanly separate its stock value from the existential threat of AI substitution.
Think about the implications of that.
If your stock is valued purely on software revenue, you wake up every single day terrified that an AI agent is going to automate your entire industry.
You're always looking over your shoulder.
But if your stock value is anchored to a pristine, cryptographically secured treasury asset, the AI revolution can wipe out your software competitors, it can automate every workflow, and you remain perfectly insulated inside your digital fortress.
Safe and sound.
You survived the SaaSpocalypse because you opted out of the game they were playing.
But to do that, it requires a profound psychological pivot from the executive class.
An ego death, almost.
Exactly. They must stop identifying as software visionaries who just happen to manage a corporate checking account and start identifying as treasury accumulators who operate a software utility merely to fund their acquisitions.
It forces a total redefinition of what a corporation actually is in the 21st century. It is an adaptation to new monetary and technological realities happening at the exact same moment.
A historic convergence.
We truly hope this deep dive has provided you with a new lens to evaluate the markets right now.
We encourage you to subscribe so you are notified for our next deep dive. And, more importantly, we invite you to actively participate in the research process.
We really do.
If you have data sets, legal filings, or market signals that challenge or expand on what we've discussed today, please share them with us.
Why do we ask for your research? Because the best ideas don't come from us sitting alone in an echo chamber. They emerge when your unique curiosity meets our analytical process.
It's a team effort.
Let me close with our core mantra because it defines the flow of what we do here. In one line, your signals are synthesis, AI acceleration, human obsession, distilled insight. That is the mission and the flow of collaborative intelligence.
We are actively asking you to help us build a symbiosis of artificial and natural intelligence.
Specifically, if you have deep expertise in corporate treasury management, or if you are a master of minimalist kinetic typography, we want to hear from you.
Your unique vantage point makes the synthesis better.
Keep searching, keep the quest on. See you on the next deep dive.
I'm Satosha.
And I'm Satoshi.